Welcome back to Property Unlocked. I'm your host, Ella. I'm a buyer agent and a property investor myself. Today, we're exploring a common question, which is how can I retire on $150,000 worth of passive income? How many properties do I actually need to do that? And today, I'm joined by Joey from the Property Strategy Podcast. Would you like to introduce yourself for the listeners?
Thanks so much, Ella. So I'm the host of the Property Strategy Podcast. I'm also the head of strategy at Game Plans, where we basically review and help people build out property portfolios. We've done almost around 10,000 over the last 5 years. So
Crazy.
I'd like to think that I've seen a portfolio or two.
Yeah. What's the most hectic, biggest, most impressive property portfolio you've ever seen?
Oh, I know we're having a bit of a chat off air about this, and we've kind of seen anything from, say, the experienced investor who's maybe been doing this for, say, 20 or 30 years, and then maybe someone who's been doing this for about 5 or 10 and everything in between.
Yeah.
There's a couple of investors that come to mind, maybe 5 to 10 years into their journey with like a portfolio size of, say, $10 million. Those ones there are pretty exciting and lucrative, and it could be, doesn't have to necessarily be the fact that they're a business owner. I like seeing it when they're a PAYG individual, because obviously business owners have the ability to drastically ramp up their income. So a couple of those investors come to mind. $10 million portfolio for someone who's only been doing it for 5 to 10 years.
So a 10 mil portfolio, how many properties generally would they actually have in that portfolio?
Yeah, obviously it depends on the purchase price and locations, but somewhere between, say, 5 and 6 acquisitions in their portfolio. And obviously they're going to be some quite sizable properties and a bit of a mix of residential and commercial assets.
Yep. Awesome. Now, it's all well and good hearing about the success stories and the people who are already there, but a lot of our listeners, they potentially haven't even bought their first property, which is a great thing. You know, you're starting with a clean slate. You can learn from people like us who have made the mistakes and therefore be better informed going into your first property purchase. So my next question for you is, what is the most common goal that people have for their portfolios in terms of passive income?
Yeah, so I mean, we typically see, some people give it a little bit more consideration than others. Most people just kind of throw around this idea of, say, 100, or that's kind of shifted towards more like $150,000 worth of passive income, kind of like 100K net, so to speak. Or some people, like I said, give that extra layer of detail and will kind of look to go, okay, I'm earning X and I'm trying to replace my income. But as a rough guide, again, having seen around 10,000 portfolios, we're kind of seeing anywhere between 100 and 150K, leaning more towards 150K as that average.
And one thing clients tell me is, well, they don't even know how much passive income they need to be comfortable at retirement. Would you say that 150K is enough for, living standards?
Yeah, for the everyday individual, and obviously that would change quite drastically, but that's kind of more than double the average in pension that someone would get. So what we're trying to do is we're trying to build sustainable portfolios that can provide people that passive income so that they don't have to rely on these government benefits to fund their retirement. It means that people can retire on their own accord when they want, on their own dime.
Yep. Great. So these people, they might be looking at themselves and thinking, well, I don't even know if I'm at that position. Can I ever be that person? So can you paint for me the average, most typical client who comes to you for their portfolio strategy?
Yeah, so if we were to kind of just use some rough round Australian averages, call it like $100,000 per person. So that's a combined household income of 200K. Let's take that as the ballpark. Obviously, there's some extremities at either side of that. But let's work from like a $200,000 household income position. And then obviously we'd like to see a fair amount of savings in the bank, unless you've got other kind of benefits available to you, guarantors and whatnot. But we'll call it like 150K of savings in the bank as well. Usually let's just work from those round assumptions in terms of the start point for this typical investor.
And how old would they be?
You're going to have to be maybe not necessarily straight out of uni to have 150K in the bank. So we're probably talking like maybe some point in their mid to late 20s to where you're at that stage where you've perhaps partnered up with someone. Doesn't have to be the case. So you can definitely get into property. I first got into my first acquisition when I must have been 20. And obviously I was a single guy at the time, and I had enough for, I think it must have been a 10% deposit. This was back in 2015. So you can see there that you can get into it on your own, and it doesn't necessarily have to be the case that you're in a combined household there. But anywhere from your early 20s to late 20s, but obviously as soon as possible.
Okay. So what I'm going to do is I'm going to take on the role of this avatar, and I'm going to say, all right, I'm 28 years old.
Yep.
I'm a nurse. I'm from Melbourne. I'm on a wage of 100K. I've got a partner. He works in construction. He's on 100K as well. What is our first step to begin building this portfolio?
Yeah, absolutely. So, I mean, what we want to do is we want to make sure that we can get ourselves comfortably into an acquisition where, I mean, we're not spending 200K for argument's sake, but we're not over leveraging ourselves and we're trying to max out our borrowing capacity and we're going to go and spend 1.2. Roughly speaking, we can say that that your borrowing capacity is about 6 times your household income. So take you and partner, 200K times 6, around 1.2 million borrowing capacity. So not going out there and just going exhausting that on acquisition number 1, but also not going too cheap and compromising the quality of asset. So we're going to put you into an acquisition of, call it, say, 600K as a start point. At a minimum, we're going to need, depending on government incentives and whether you're moving into the property or not, let's just put on an investor hat to start out with. We're going to need to call it a 10% deposit, or in some instances, most brokers like to put you into, say, an 88% lend. So we'll put down a 12% deposit on that $600,000 acquisition. And for all these purchases, just to use some really nice round numbers, let's just call it like a 5% rental yield moving forward.
Yep. Awesome. So with that budget, my partner and I, we're looking at properties. I found one north of Melbourne, $600,000, rental yield just shy of 5%. This will be our first property, okay? So a house on a good sized block of land. We buy it, we rent it out, we're all good. How quickly should I be buying that second property? Because I've still got 600 grand left in my borrowing capacity. So what's that next property looking like?
Yeah, so I mean, using a combination of some savings over time and hopefully some equity growth in your first acquisition, we're then going to get you into another property. And what we usually would be kind of doing for that first amateur investor, for example, when you're buying your first acquisition, your following year is that year of building your savings buffer back up again, allowing that first acquisition some time to grow, and then call it 18 to 24 months after your first acquisition, we're getting into your next property. So call this, in your instance, 2027. You're getting into your next acquisition. And what we're going to do is we're also going to factor in market movement. We want to make sure that you're getting into the similar quality of asset that you bought in 2025, but we're buying it in 2027. So we're actually going to tell you that you're probably going to be spending a little bit more, like 675K on that second property purchase.
Alrighty, sounds good. So to recap, I have to wait, let's say, a year and a half. At that point, I've built some solid equity in my Melbourne property. I can refinance that one, extract that equity as part of my deposit. And my partner and I have continued saving. So now we've got another deposit to go for property 2. And, you know, inflation happens, capital growth happens. We can't afford to buy in Melbourne again. So now we go and we buy a house in, let's say, regional Queensland, and we buy in Townsville. Would the rental yield be similar?
I mean, you're probably going to be looking at a slightly higher rental yield, but what that might do is maybe counteract the sub 5% that you got from your first acquisition. So maybe overall we're starting to average out at around that 5% mark.
Okay, so now we've got the second property. And it's rented out. It's all going well. The growth is good. Haven't I tapped out of my borrowing capacity?
Well, look, you're actually starting to, because time's gone by, we're going to assume that, obviously you mentioned inflation happening. With that, we'd like to think that at the very least your wages would increase with CPI. So call that 2.5%, 3%. So you're going to get those slight incremental increases. And on top of that, with that original formula that we did where we said 6 times household income, we now have to start factoring in the rental income coming through from properties number 1, 2, and the future rental income coming through from property number 3. So we're not quite at your borrowing capacity ceiling just yet, and we could get you into another acquisition. But what we would again do is give you that year off after your second purchase, allow time for the savings to accumulate again, by which point property number 1 has grown in equity. Property number 2 is actually now starting to get a little bit of traction as well. And then we're going to get you into property number 3. And for this acquisition, again, we're talking about perhaps 2029 here, keeping in line with the market movement. Let's call that a 750K acquisition.
Okay. Should I be selling the first or second property to get into 3? Do I need to do that?
Ideally not.
Okay.
Ideally not. So, I mean, we'd much rather do the whole kind of equity release extraction like you mentioned for property number 2, because ultimately if you're going to liquidate that asset, it's a pretty costly exercise getting in and out of property. You're going to be paying roughly, we call it, say, 3% in terms of your selling costs. And then that's not even factoring in capital gains tax. So if we can hold the properties, we would much rather you do so. In addition to that, if you were to sell property number 1, for example, you've now lost the rental income. And we're trying to build out a little bit of a portfolio here that's going to provide us some passive income.
Okay, so the strategy is all buy and hold solid asset, so we're getting that equity growth. But given we're not selling, do you think it's a good idea to renovate the first or second, build a granny flat? What are your thoughts on these value add ideas?
Yeah, so I mean the cosmetic renovation is a really good play. I mean, at the moment, cost of materials may be kind of dampening the return that you might be able to get. Once upon a time, you could put, say, $1 in and get $2 or $3 out. Now maybe it's more like $1 in, $1.30 or $1.50 back from a renovation return perspective. But it could be a really good way to get some short-term uplift. Getting some short-term uplift in terms of the growth is going to allow you the ability to pull that equity out and help you get into the next acquisition. But that last one that you mentioned there, that granny flat addition, that could be a really good play in terms of helping to really kick on the cash flow. Personally, I'd probably rather save that for the end of the accumulation phase.
Okay. All right. So we've bought the third property, and let's say the third property was in Bendigo, all right? Regional Victoria, you're going to get a good yield there. It's still a foundational type asset. Now we're holding that one. It's rented out. It's all going well. How am I getting to the fourth property? This is the common question. How do you get to 4+ properties?
Yeah, I mean, there's a few kind of different factors at play there, and then we can start to unpack the whole topics of potentially making acquisitions under different entities. So we start to talk about purchasing properties under, say, trust structures, which is the topic of much debate at the moment, and this whole preservation of borrowing capacity and unlocking unlimited borrowing capacity, quote unquote. So we can start to kind of delve into some of those fields there. But ultimately, by this point now, we're kind of talking about, say, 2030. We're a few years from now, our wages, hopefully if we're in our kind of mid to late 20s, hopefully our wages would have increased. We're now starting to push into those high income earning years. Our portfolios are hopefully by this point largely self-sufficient, given the fact that we may have started from a slight negative cash flow position.
So the rent is covering all the costs.
The rent's starting to cover the outgoings. Our wages are starting to increase. And we really only, for this portfolio here, trying to chase 150K passive income, we only need to push into that one more. So one more additional asset when, like I mentioned, maybe we start to think about making acquisitions under perhaps different entities, or if we could, from a borrowing capacity perspective, push into that last property purchase, that would be the one that gets us to that end goal. Not straight away, but over that kind of 15 to 20 year time horizon, that's when we're really starting to push the needle there in terms of chasing that passive income target down.
And at what point do you see your clients begin to pay down their principal debt as opposed to just doing interest-only loans? Because interest-only, that's great for the cash flow, and that'll help you hold on to the cash to get into the next one. But shouldn't you be paying down the debt during this time?
That's a really good kind of topic that you bring up there, and that is part of the reason how we can potentially continue to scale the portfolio, that interest-only piece there. Yes, it comes at the cost of paying a little bit more interest over the life of the loan. The interest rate is usually a little bit higher. At the time of recording, we're talking about 0.3 to 0.4% difference relative to a P&I loan. But the lower repayments in terms of the better cash flow position that interest-only gives you allows you to scale from property 1 to 2 to 3 to 4. And then at a certain point in the portfolio, usually after accumulation phase. So we want to try and make sure that we can maximize our borrowing, get into as many acquisitions as we need, not as we can, but as we need to actually chase that goal. And then once the portfolio is self-sufficient, then we can start thinking about the debt reduction piece, which has a few elements involved. You can either slowly roll these loans over to P&I. You could potentially, at a later point in time, liquidate an asset to help retire out some debt. Or you could just keep rolling IO for as long as you possibly can. Keep building your savings up to a point where your savings outstrip the amount of dollars that you hold in debt. And then you can contact the bank and say, hey, I've got more cash in offset than I do in the loan balance. I want to pay this thing out.
Yep. Okay. And do you see more value in having cash in that offset account, or do you see more value in just paying down the debt? What are the pros and cons?
Yeah. So, I mean, this is me personally speaking. I don't want to give any kind of specific financial advice, but I personally I would go down the avenue, and I am going down the avenue of holding my loans interest only. Again, giving the bank the absolute minimum, and I'm just holding that surplus in the offset account. So as we know, for every $1 that we hold in offset, that's $1. We don't pay that amount in interest. So for a $500K loan, and we've got $100K sitting in our offset account, we're only paying interest on $400,000. So me personally, I would rather fill my boots from an interest reduction perspective, but also I'm more liquid. Now I've got the money in
Yeah.
my account ready to go for that third purchase or that fourth purchase. And I'm not relying on knocking on the bank's door and saying, hey, my LVR is good. Can I borrow can I pull some equity back out again? And ultimately, that's at the bank's discretion. Whereas if that money's in my offset, I'm liquid and I'm ready to go.
So just to clarify, what you're doing personally, you're on all interest-only loans.
Yep.
And it's not until you've finished buying those 4 properties that you're then going to start paying down your principal debt.
Yeah, absolutely. And so the only kind of caveat to that would be if someone has an owner-occupier.
Yeah.
So if you've got an owner-occupier, well, then that property there would probably be a principal and interest loan. And again, that would probably even put it even more in the favor of my investments in that instance would definitely be interest only, because I want every single dollar of mine to be either in the offset account against my own occupier or paying down my own occupied loan.
Yep.
Why? That debt is non-deductible, whereas the debt against my investment properties is tax deductible. So I'd rather have a higher debt position against my investments because it's deductible from a tax perspective. And I want as low a loan balance or as much money in the offset against my owner occupier. So that would, having the owner occ would put even more votes in the camp of going IO for my investment properties.
Yep, I hear you. Now, one thing I want to touch on is the benefit of buying in a trust structure. I mean, you've seen 10,000 property portfolios. So, you know, if there was a drastic benefit to buying in a trust versus buying in your personal name, should you be buying in trust from the get-go from your first property, or do you see value in, buy in your personal name and then bring in the trust structure?
Yeah, really common question that we usually see. And to be honest, I mean, the individuals need to go and seek the advice from their accountants because their accountant's going to know their individual circumstance the best. But usually, as a rough rule of thumb, we're kind of seeing people going and making 1-2 acquisitions in the personal name, taking advantage of, say, for example, things like negative gearing benefits, which you don't get inside a trust structure.
Yeah, true.
And it's only when, I mean, depending on the purchase prices, usually when people get into, say, acquisition number 3 or 4, then they start to explore the trust element. We want to make sure that they preserve some borrowing capacity in their personal name. Otherwise, they can't qualify for finance in the trust. That's a really important point for the listeners. Don't go and max yourself out from a borrowing capacity in the personal name and then just think that you're going to be able to automatically unlock this borrowing in trust. You still have to have serviceability in the personal name.
Yeah.
And then preserving some. And then usually for, say, acquisition number 3 or 4 is when we start to employ that trust structure.
Okay.
And the reasons why people would do that is exactly what I mentioned there. It's the preservation of some of that borrowing capacity and also things like asset protection and, say, intergenerational transfer of assets. But the kind of the thing that's got the hype at the moment is around, say, preservation of borrowing capacity.
That's a big thing.
Yeah.
Like,
and what
your debt is invisible once it's in the trust.
Correct, right? And that's what like people are talking about at the minute. But it's not from the outset, right? There's a couple of conditions behind it. And there are only a few lenders that will actually exclude that debt held in trust. But the key kicker to this is that trust needs to be self-sufficient from a cash flow perspective.
Yeah.
So if you buy a property and it's got negative 10,000 in carrying costs,
Yep.
you can't hide that trust debt because it's not self-sufficient. That trust genuinely, or that property held in trust genuinely needs to be self-sufficient from a cash flow perspective. Your accountant needs to be on board and has to provide a letter saying that property is. So there's plenty of moving parts at play. It's not as simple as, I'm just going to go buy a property in a trust and I'm going to keep unlocking my borrowing capacity. It's not as simple as that.
Yeah. Cool. Alrighty. So I've bought 3 properties now. I've got the house in Melbourne, the house in Townsville, the house in Bendigo. Now we're on to my 4th property. How old would I be by this point?
We are in the year 2031.
Okay, so I've bought the 3 properties. I'm 34 years old now, and now I'm really excited to get into the 4th.
Yep.
Should the 4th be a commercial property, or should I be sticking to residential?
Well, I mean, it's usually at this point here where we might see people start to transition towards that commercial space. Why? Ella, you're starting to push the needle in terms of borrowing capacity, like we were mentioning a few minutes ago.
Yeah.
And then, I mean, we can chat about this in a little bit more detail. Potentially, we might even save this for another podcast. But we usually see people start to transition towards that commercial property towards the back end as we're starting to cap out in terms of borrowing cap.
Yeah.
I'll maybe push some of your buttons in terms of giving us a little bit of information as to why we would see people do that. In addition to it potentially unlocking a little bit more borrowing capacity, it's also going to drastically start to ramp up the cash flow. And especially after we've got a little bit of a base of a residential portfolio, we then might start to see the transition towards commercial. But for this instance here, let's just go with another resi asset, and we're going to then keep in line with that 600K target purchase price. We're going to account for 6% growth moving forward. And now we're going to tell you that you're going to be needing to spend minimum $800K on this property.
Okay, great. So $800,000 budget. I've still got my borrowing capacity. Was I buying this one in a trust or still personal name?
So this one here could be entirely up to you. For the purpose of modeling here, I'm going to put that one there in a trust structure. From a numbers perspective, it's not going to fundamentally change where we're going to be in that kind of 20-year target where we were chasing the 150K. So either or, obviously go and seek your counsel from your accountant. And maybe it was property 3, potentially that was bought in a trust, or maybe it's this one here, property number 4.
And what rental yield would I need?
Yep, so we're going to go 5%. So averaging out across all the properties, we're going to be talking about a 5% rental yield.
Yep.
And then we're going to be basically finished that accumulation window. So we're kind of 6 years down the line. We've got the 4 assets in the portfolio. And then we're just going to let time do lots of the heavy lifting beyond that point. We're still going to keep working. Like, we're not retiring in 8 years' time. This isn't a get rich quick scheme. It's actually a get rich pretty slow scheme. But if you don't mind, let's fast forward to 20 years from now. Let's fast forward to 2045.
Okay, 2045, let me recap the portfolio. House in Melbourne, house in Townsville, house in Bendigo, and that 4th property, I bought a house in Perth, and the rental yield is 5%. So let's rewind it back to when I've just bought the house in Perth. What is my cash flow like overall?
Yeah, so by this point here, we're pretty close from a self-sufficient cash flow perspective. We're actually around $2,000 out of pocket to hold your entire portfolio.
For the year?
For the year.
Okay, great. That's awesome.
So the previous year, we were running a slight profit. And then when we buy again, we start to eat into our offset account. So therefore, the amount of dollars in offsetting interest reduces. And then we start to dip back into a little bit of negative cash flow territory. We're also assuming interest rates stay where they are now. So if they were to come back down to, say, levels in the high 4s, for example, well, then your cash flow position would be better than this. But largely self-sufficient from a cash flow perspective at the end of your accumulation window.
Yeah. Okay.
Usually if we kind of break the portfolio up, it's like the first decade is nothing to kind of write home about. It's usually a bit of a hard slog, right? Most of your dollars are going towards either the next deposit or the carrying cost for your portfolio. It's not until that next decade that you start to actually see some movement and you start to go, that's why I'm doing this. That's why I'm doing this. And that's the following decade that you can then start to enjoy the fruits of your labor and your hard work.
Yep. Okay. So at the age of 34, I've bought my 4th property. You know, the cash flow is okay, just slightly negative. When am I going to achieve that 150K passive income?
Yeah. So what we need to do firstly is we need to inflation adjust your passive income target, because if you were just chasing 150K, you're going to be pretty disappointed in 2045 with what 150K buys you.
True.
So I'm going to tell you, Ella, you actually need a little bit more like 250,000
All right.
in 20 years' time to keep kind of comparable with what 150K buys you today.
Yeah. Sure.
So if $250,000 of passive income is our target, I'm now going to tell you that you should be on track to be producing around $270,000 worth of passive income by 2045. So your target has been met there within that 20-year window.
Awesome.
About 15 or so years after the end of your accumulation phase.
Right. Okay. Awesome. Fantastic. So that's really not that hard. Four houses in total, 4 properties.
And that's the thing, right? People come into this with a preconceived idea of I need 15 properties or I need
100,
28 or 100 because it looks great. And I've read that on an article. And
it's just an ego thing.
That's all it is. But at that point there, because you can see here, if you this person pushed beyond what they actually needed, they're just going to be increasing their debts for debt's sake. They're going to have potentially a little bit more passive income at a later stage. And in some instances, and having seen this across many portfolios, adding more and more and more properties in, even if you could buy it, may actually delay your passive income target. Now, why could that be the case? You're adding in additional debt. And if the interest rate is higher than the rental income coming through, you're actually going to be pushing the needle a little bit further away from you. So that's why we always like to start with the end goal in mind and reverse engineer that back to, okay, well, what do we actually need? And in this instance here, it's 4 acquisitions. After you buy this property, you're already a quarter of the way there.
Yep. So we achieved that goal of 250K by retirement, and we reached retirement at what age?
We were 48.
48. That's pretty good.
That's pretty good, right? And you know what? The other thing as well in on top of that is if we step that back, say, 5 years, right? Let's go to 2040. We're still sitting on $145,000 worth of cash flow.
Yeah.
Like, that's not a bad news story either. Now you're already starting to talk about, well, I can work part-time, or I can go and start a business. I can go and work on a passion project because I know.
I was thinking I can go to Europe.
Yeah. Whatever your cup of tea is, because you know you've got that backing behind you.
Yeah.
You know you've got some kind of passive income coming through, and then as the years go by, your rents increase, just like we have capital appreciation in terms of the value of the property. Our rents also increase, potentially not at the exact same rate, but we still do get rental income increase around, say, 4 to 5% on average year on year. So then that's going to continue to increase as well. And what you'll notice is that you'll actually probably outstrip your inflation-adjusted passive income goal as the years go by.
Yep. So you achieved that with 4 houses and you never made any renovations?
Nope. So we haven't kind of explored a value-added play. We haven't spoken about the granny flat addition.
Yep.
And like we were mentioning before, where we would usually see that come into the portfolio is at the end of that accumulation phase.
Yep.
Now, why we might do that is we want to make sure that we're preserving our borrowing capacity for acquisitions.
Yep.
Right? Because it's probably going to be, it's going to be a little bit easier to say front up 200 or to find $200,000 for a renovation than it would be to find $800,000 for your acquisition. So get through your acquisitions first. At the end of the accumulation phase, we then come back, look at our assets and go, okay, what has the ability to come in and reno, add a granny flat on? Is there a subdivision potential? So we want to get through our acquisitions first, and then we come back and look for the value add plays.
What would be the best value add play? Do you believe renovation is best or granny flat? Like, is there a secret hack I don't know about?
I mean, it really comes down to what you're trying to achieve. So the cosmetic renovation is usually a play for, say, some short-term equity uplift, whereas a granny flat addition, my personal belief is it doesn't necessarily add all that much value to the property. In some instances, it actually could come to the property's, well, not necessarily detriment, but almost detriment in terms of capital appreciation. Because if we talk about property appreciation coming down to owner-occupier appeal, lots of owner-occupiers don't love the idea of half your backyard being chopped off with a granny flat being on there. They want a nice big backyard so you can put in the soccer posts and put in a nice pool one day. But what that actually solves the cash flow problem. So we can still get ourselves into a great blue chip asset where the yield may not be there. But how we solve that is with the granny flat addition. So we've still got in an A1 location where the yield might have not been that strong. We come in, we put the granny flat on there. All of a sudden, we're now achieving like a 5-6% yield on that as finished value there.
Yep. Now, are we ever selling any of those 4 houses?
You could do. I personally wouldn't. So if you didn't need to, and in this instance here in the modeling, we haven't done so.
Okay.
So ideally, we want to make sure that we can hang on to these properties. If we sold one down, then what we'd see is, yes, a reduction in terms of debt, but also a lost income stream coming through from these assets.
Yep.
So it really comes down to, do you need to? And that's going to come down to how quickly you can save up as well. Because if we can save, and like I mentioned in one of the debt retirement strategies there is, if we can save to the point that our savings start to outstrip the amount that we have in offset, we're basically fully offset there. Even if we're carrying debt, we've got more money in offset than we do with debt. We could pay that out, or we could just continue to hold that.
Right. So if you don't need to sell for the debt consolidation phase, like, you can hold on forever. So it's purely for having that income stream during retirement. You personally, would you hold on to these properties and pass them down to your kids, or would you sell at some stage?
Yeah, so for me personally, I would rather hold as many assets as I could without necessarily selling. Not to say that selling wouldn't and hasn't formed a part of my personal portfolio, because I'd be lying if I said it didn't, because it has. Yeah. But it always has to serve a purpose, right? So selling for me would be the asset wasn't great and there's an opportunity cost of holding it. Selling would be potentially selling an owner-occupier and upgrading it, capital gains tax-free gain. Selling would be debt reduction, so that would be a purposeful play. And why might we do that? Well, we got to a point where, okay, I've got more than enough coming through in terms of cash flow. I just want to reduce my debt.
So what we've been able to go through in this episode is you really don't need 10 plus properties. You only need 4, and you will retire with comfortable passive income. You know, 150K in today's dollars, but 250K in 20 years' time, okay, which is fantastic. That gives you freedom. You don't have to rely on the government. You don't even have to rely on your super, right? Exactly.
And that's going to be in on top of all of this, right? So that's the other added and potential other exit strategy as well, is that if you're carrying debt into retirement, well, retirement. You've still got $250,000 of passive income coming through. But that's the other strategy that people employ is they potentially use their super balance because you're still working through this period. And
We didn't even tap into our super.
I know, we haven't touched it. But you could use your super balance
That's very
in
conservative.
retirement.
You're not like the other property gurus. Roll your super into an SMSF.
We can talk about that. It's something that I've personally done as, myself. So I just don't want to go out there and be one of those
Promoting
trumpeteers.
it,
But
yeah.
like it is a strategy that we do see people employ. Something that I've done. Again, it could be a way that you could kind of get around some of those borrowing capacity constraints that you might face in your personal name. It doesn't even necessarily have to be about that. It could just be the case of what the hell is my industry fund actually investing in? I have no idea. Or I'm a property guy. I live and breathe property. I don't know shares. So I would rather than take my super and put it towards an asset that I know and I believe in, I trust in, and I have been investing in for over a decade.
Yeah.
So I would rather my money sit there, or my super sit there within that asset class, and I can get leverage.
It's not for everyone.
Not for everyone,
though.
absolutely
It's probably not for the majority of people.
I would agree with you.
Yeah.
I definitely would agree.
But that's great. And I'm saying that the majority of clients are considering SMSF, but the majority of clients have already bought multiple properties.
And that's where we would usually see it as well. Very, very rarely would you see
Yep.
someone walking on the street and go, I have no properties. I want to buy one in SMSF.
Yeah, no.
It's usually like, I've got 4.
Yeah.
And now I'm thinking about SMSF. And you also need a fair balance. So you're not like strolling out of uni with your
Oh, no.
2,000 in super that you've accumulated from
the
McDonald's.
cafe job.
So you're going to need to be in like a full-time workforce. We're usually seeing people in their kind of mid-30s when they kind of got that 200, maybe 250K combined super balance.
Yeah.
Start to think about purchasing property through an SMSF.
Right. So this whole strategy of buying 4 properties, having that comfortable retirement, it's a slow and steady
Slow burn.
strategy. So you're accumulating over, was it 10 years?
Accumulating, like the window was about 6 to 7 years.
6 to 7 years of hard slog, in debt, saving deposits,
Yeah.
Praying for
All that
equity
good
growth.
stuff.
So it's not get rich quick. It's actually get rich incredibly slow. But with that being said, it's good to know that it's not that hard. It's 4 properties over 10 years. That's a long time.
Super achievable.
And you're doing it with a partner as well. So you have support there and you get to rely on each other. When one couple has a pay rise, capitalize on that.
Boom. Take that.
Fantastic. One thing that we did not touch on, and this episode has been very much investment focused. We have not touched on buying the home, the owner occupier. And that's one thing most clients will bring up. They want to buy their family home in 5 to 10 years' time. So what we'll do in the next episode, we will be tying in when you should be buying a family home, if you should ever be buying a family home, or if you should stick to investment. So make sure you guys watching follow along, subscribe to this podcast, and stay tuned for that next episode.
Cannot wait. Chat to you on the next one.
Thanks, Joey.
See ya.